Hi, Alissa. Thank you very much for joining us today. Kopernik Global is based in Tampa, Florida, and manages around $6 billion in assets, and the mandate of the firm is value investing. Where do you and your team see value currently in this market?
Thanks, Jimmy. It's really great to be here. Currently, I mean, we've talked a lot in the past about how expensive the markets are, and we still view the US as being very expensive, fixed income, very expensive, but there are really good pockets of value out there to be found. One is in emerging markets. So we own half of our portfolios in these high quality franchises, cash flowing businesses, market leading companies in emerging markets. And then half of our portfolio is in commodities and resources and real assets. So 25% of our portfolio is in gold mining, which I know we've talked about uranium. So I'm excited to talk about gold today, because that's really our highest conviction area.
And maybe you can dive deeper into that. Why do you have such a strong conviction for gold and gold equities?
Well, gold we believe is underpriced. It correlates very well with the monetary base, and that has really been dislocated since 2011. The monetary base is up, roughly 3 times since 2011, where gold is flat, and then gold miners are down 50% from that point. So really, gold miners are an incredible value, even if gold doesn't go higher. But we do think that gold does go much higher from here. Many people will say, well, gold is this, pet rock. What's the point of gold? And we say, yeah, you can't eat gold. You can't put it in a car. You don't consume gold. It doesn't sound like a commodity, but it does sound like money. You also don't consume your money. You don't put your money in your car. Money is a very good, to be a good money, you need to have it be a good medium of exchange and a good store of value. So gold has been money for thousands of years. It's inert, it's homogeneous, it's portable, it's visible, all those things that you need it to be a good medium of exchange. And paper money really is probably a better medium of exchange, because it's easier to transact in. However, for it to be a store of value, which money also needs to be, it needs to be scarce. And paper money, as the central banks have shown, is anything but scarce. And so, in these times of central bank printing, where you increase the monetary base significantly, now we're starting to see the symptoms of that, with rising prices and interest rates are not high enough. We now have negative real rates, and that's usually sets up for a very good environment for real assets. People are losing money, 3 to 4% a year. Eventually, they will, they flee to safety. They flee to scarce real assets, things that can't be printed out of thin air. So gold does very well in those situations. The 1970s is a great example, where gold went from $100 to $800 an ounce over a period of 4 years, when you had these negative real rates. So today is very much like the 1970s. So we do think that gold does go higher, but the gold mining is great, because you don't even have to have high expectations for gold for them to do very well.
Alissa, you raised a lot of very interesting points there, and I just want to clarify one point. You made mention of the fact that gold since 2011 has more or less been flat, but yet the money supply has gone up 3 times. So if I understand you correctly, in the way that you and your firm look at it, the price of gold should also go up 3 times, or it should move in correlation with the money supply?
It should. Now, you have to, we think about gold in a number of different ways. We use a number of scenarios in our gold valuation models. One is a bear case, that gold goes to 1,000, and effectively all these mining companies are not worth very, very much in that environment. The other is we look at, okay, well, what are these gold mining companies worth at just current liquidation values? And many of the equities are trading below the price today. And then we say, okay, well, if we viewed gold as a commodity, what is that price that would incentivize new supply? That's how we come up with our anchor for copper and uranium and those sorts of things. There are no new gold mines being built today of scale, and so you really do need to see north of $2,000 an ounce just to bring on new supply. So that's another indicator that the gold price is too low. Then to answer your question more directly, you look at, all right, well, what is gold worth if it is money? And over time, gold has backed the monetary base. The percentage of how large of a percentage it needs to back the monetary base has changed over time. In the 1980s, gold more than backed the whole monetary base. It was 100% backing. In our valuation models, we're saying, okay, well, what if gold backed the monetary base by 25%? What does that look like? And to your point, yes, it's multiples higher than today. That's just one scenario. And as I mentioned, the gold mining companies are trading below just the current price today. So we get that free call option on a rising gold price.
Alissa, you made mention of the fact that 25% of your AUM is allocated toward gold equities. I want to discuss diversification and the importance of diversification, beginning with how many names do you own in the
gold? We own more than 20 different gold mining companies, and diversification is so important in the mining sector. It's a very tough business, so a lot can go wrong. On the mining side, maybe you don't have as many ounces as you think you might have. Maybe the metallurgy is different than what you expect. So lots can happen just operationally that makes mining a challenging business. Then you have, on top of that, you can't just pick up and move your mine to a different country. So there's geopolitical risk. Sometimes governments want more of the action, especially when the prices are rising. We're seeing that in Chile, for example, with copper. And then you have management teams which have balance sheet issues. So historically, the gold mining sector has not had the best capital allocation. They've not made wonderful decisions. So that's an additional risk factor. And so because of all of that, it's important to own a lot of different mining companies. And you can still do well even when some of your companies don't work out. For example, in 2016, we had one of our largest positions. It was a coal mining company that was effectively stolen away from us, and our portfolio was up 50%. So, diversification is important because it can diversify some of these idiosyncratic risks.
I want to move on now and examine valuations. What gold price do you use to value equities?
As I mentioned, we run a number of different scenarios. So we weight those scenarios and come up with what we think that the gold mining companies are worth. Importantly, we don't value these companies the way that the market does. The market tends to use DCF models, which we think they're misapplying a model that works really well for bonds. If you're going to get cash flows over the next 10 years, fixed cash flows, you would expect that the cash flow that you receive in 10 years is not going to buy you as much as the cash flow that you got in year one. So it makes sense to discount. However, a mine is very different. Gold actually holds its value over time. It rises generally over time in a depreciating currency environment. And so what we think people are doing is actually, by using a flat gold price and then putting a positive discount rate on it, they're actually saying that gold is losing value over time, which is flawed logic. So we value just the reserves in the ground. And I should mention that the result of using a DCF model is that the long-life mining assets are undervalued. So if you're choosing between mine A and mine B, and mine A has 15 years of mine life and mine B has 50, at a certain discount rate, you're getting no value for those years 35 and beyond. You're indifferent between the two. Whereas we say, if you're gonna own a mining company, you'd much rather own one that has 50 years of reserves rather than 15. So we value the ounces in the ground. And we say, okay, if they have 10 million ounces, it's gonna cost them $1,500 an ounce to pull it out of the ground. Each ounce roughly is worth $500 an ounce. That's the margin that they're going to get on that. Then we subtract out any capex that they will have to spend, all their liabilities, and that's our theoretical value. And then talking about all the risks that they face, then we want a huge discount to that. And some of our discounts are between 60 and 80%. So we haircut it. We'll haircut it 80%, and then if there's upside to that price, that's when we buy. So these are the sorts of discounts that we're seeing in the marketplace today, and we're seeing that there's multiples upside to that risk-adjusted intrinsic value.
So let's try to quantify that. When you look at gold producers, generally speaking, what gold price are they factoring in?
It's so interesting because we just went to the BMO conference in February, and you talk to a copper mining company, a CEO, a nickel CEO, and they all have an idea of what copper's worth or nickel's worth. You ask a gold mining company what gold price they're using in their models, and they say, oh, we just use consensus. Well, who is consensus? Who is this magical consensus? Well, it's a consensus of analysts on Wall Street, and how do they know more about what the gold price should be than the CEOs of a gold mining company? So anyway, everybody seems to be using $1,600 an ounce, which goes clearly below today's level and well below what we think gold should do, which is go much higher.
And how do current valuations compare to the last cycle? And I'm just trying to get a sense of how cheap gold equities are now compared to what they were in the last 10 years.
Yeah, absolutely. So the fall of 2015 was a godsend for a value investor. March of 2020, obviously, they got very cheap. They fell in half for really no reason. And then, I mean, today they are still very inexpensive, and so we only go to 25% of our portfolio in rare circumstances. That's our max in any industry. So that's the level of conviction we have in these gold mining companies over the long term. There's they very well could fall over the next 6 months, but we're long-term patient investors that have a time horizon of many years.
I want to move on now and discuss M&A. We've seen a lot of M&A deals in the last couple of years. Currently, we have Newmont trying to buy Newcrest. You've mentioned in the past that Newcrest was one of your larger holdings and you thought there was very good value there. What do you think of Newmont's bid for Newcrest, and does it represent good value?
As you mentioned, yeah, Newcrest is one of our largest holdings. And if Newcrest already rejected one bid of Newmont's, and so maybe they come back with a higher offer, and should Newcrest accept, we would think, depends on the price, but I would imagine maybe 20-30% higher than what they originally offered. That would be a steal for Newmont. In general, what we're seeing across all sectors is that companies in the US are trading at a much higher premium than outside of the US, and then even more of a premium to emerging markets. So Newcrest, we think, has 4 times upside, where Newmont, we're thinking more has 2 times upside from here. But it also speaks to this interesting phenomenon in the mining industry, which is that these big companies all have the same issue, which is that their reserves and their resources are depleting and they need to replace those reserves. So buying each other doesn't actually solve that problem. You have this match made in heaven where these developing companies who are sitting on deposits that don't have the expertise they don't have the balance sheet to actually develop the resource, are just begging to be acquired by the likes of Newmont or Newcrest. And so it's odd that they would be choosing to merge with, acquire another large producer rather than buying up a bunch of these smaller companies sitting on deposits that are trading at much cheaper valuations.
So bottom line is Newmont's going to have to make a higher bid.
Well, we hope, yes. I mean, Newcrest already rejected one, but we hope they reject a further.
I want to move on now and discuss the U.S. economy. U.S. regional banks have been decimated in recent weeks. Silicon Valley Bank has been wiped out. First Republic is down 90% on the year. Key Corp is down 30% on the year. Credit Suisse was forced to merge with UBS. How does this crisis in regional banks impact your view on gold?
It doesn't change our view on gold. Hopefully it's waking other people up to the fragility in the system that we've been talking to our clients about for many, many years. You just have too much debt in the system. And with many years of easy monetary conditions, you have a lot of malinvestment, and it seems that that's all coming to surface now. Gold is the best form of money. It's the one that doesn't have any counterparty risk. So maybe people start thinking about that when they're starting to think, oh, how safe are my deposits here, and what loans did my bank make? Maybe it starts people thinking in terms of trying to find some safety in real assets.
You mentioned earlier that you and your team were at the BMO Mining Conference, which is held in South Florida every February. Can you give us some takeaways? What were themes that you've noticed this year that you didn't notice in previous years?
Well, they changed the name of the conference. So they added critical metals. So everything is, and this is not new from other years, but battery metals is all the rage. Everybody seems to love copper, and we like the supply and demand fundamentals for copper too, but gold is, nobody loves gold. Nobody thinks that gold's going to go much higher. So as a value investor, that's always a great thing to judge the sentiment. And
so to your point, if you're a contrarian investor, this is very bullish for gold and I guess negative for battery metals.
Yeah, there's not a lot of optimism priced into the gold price or the gold mining stocks in particular. Yeah.
Alissa, as we wrap up, the narrative for gold has never been more positive. Inflation is at 40-year highs. We have a financial crisis with U.S. regional banks, which seems to be spreading globally. Do you feel it's different this time? Is this the time gold breaks through $2,000 and keeps going?
It certainly, you would think so. However, I've been surprised that the NASDAQ is up after the Silicon Valley Bank failed. So it still seems that people have this risk-on mentality, and they've been very well trained to buy the dip. So who knows how much longer this cycle is prolonged? But we tell our investors, cycles, the Fed has prolonged cycles. They have not eliminated cycles. So eventually, we would expect our gold to react positively, and the gold miners to do very well as well.
Well, Alissa, as always, that was a very fascinating discussion, and I want to thank you for spending time with us today and sharing your views on gold and gold equities. Once again, thank you.
Thank you. Thank you for having me.